Subscribe to LearnCab and hit the bell icon to get notified.
Hello friends, this chapter is the initiation of what will be a continuation of 3 chapters in which we'll be learning more about alternate investment opportunities in the capital markets. Since this chapter is not really involved with capital markets, you need to know a little bit about what this chapter is all about. This chapter is called as money market, and it is going to be focusing on the aspects of investments which are less than 1 year in maturity. That basically means that whenever a security is invested, you need to not only know about the return on investment on those securities, but also about when are you getting your money back. And all the instruments in the money market are going to be having a maturity of generally less than 1 year. Let's get right into the lesson outline. The first is obviously going to be the features of money market and what are the different ways in which you could make money in this market, followed by a comparison with capital markets and what are the comparative advantages, what are the reasons for the growth and structure of money market. And this is the most important part of the chapter, that is called MMI, which is called as money market instruments. Some of those are the treasury bills, certificate of deposits, intercorporate deposits, which we'll be calling as ICDs for short forms, certificate of deposits we'll call as CODs, treasury bills we'll call as TB, commercial bill as CB, and commercial paper as CP, followed by what is factoring and bill discounting. That is a very small chapter. So let's get right into the features of the money market. As I've already told you, money market is a market which focuses predominantly on financial assets up to a 1 year maturity. So these are not only coming under capital markets as a subject, these are mainly controlled by the Reserve Bank of India for multiple reasons, because all of these are financial instruments which invest in the financial assets of the company. Therefore, the characteristics are, the biggest one being liquidity, that is the ability to convert these instruments into cash quickly. So you can sell these instruments really easily in the money market. So we have let's say all the markets, we will call them as securities market, under which we have 3 major types. We have the capital market, the debt market, and the money market. Capital market, since capital is mainly preference shares and equity shares, we have already discussed this in the second chapter. Debt market mainly focuses on debentures and bonds, whereas money market focuses on these securities which I just mentioned. And if you notice, all of these are existing only to create a balance between the short-term surpluses and deficiencies. All of these securities will only meet your short-term financial requirement, not long-term. And since there is significant liquidity involved, these instruments only end up influencing the liquidity of the entire economy. And they are also the main reason why the central bank of this country, that is the Reserve Bank of India, is playing such an important role and intervenes in the policies in relation to the money market. In addition to this, all the money market instruments provide access to the users for short-term funds to meet their requirements for a reasonable and realistic price. They're not very expensive like equity shares. There's no significant premium component generally. Most of these are either issued at par or discount. So these are some of the features of the money market. Let's see how it stacks up with capital market. So we're going to go with point of distinction, that is the point of difference between them, and money market and capital market being the 2 markets. The first being maturity period. As you have guessed by now, maturity period is lower for money market. These are mainly short-term financing options, whereas capital markets mainly deal in long-term financing in general. So maturity is different. Credit instruments here being that the main credit instruments are these 3. A word is missed here. So call money, treasury bill, commercial paper, and commercial bill. These are the major instruments you will come across in the money market, whereas the instruments you will come across in capital markets are stocks, equity shares, preference shares, sometimes even corporate deposits are part of capital markets. Furthermore, the main institutions which are governing money market is obviously the central bank, which is Reserve Bank of India, other commercial banks, non-banking financial institutions, etc. Whereas capital markets, the biggest authority obviously is SEBI, which is the watchdog, but under that the main institutions which work are the stock exchanges and also commercial banks. If you notice the similarity between these two, that is commercial banks, is because banks sometimes invest in long-term instruments, sometimes invest in short-term instruments, because bank will need money at different intervals and different maturity periods. That is why banks are a major participant in both of these markets. Furthermore, the regulation of the money market is mainly under the hands of RBI and it's much more closely regulated, whereas capital market is not as closely regulated as money market. The risk is definitely one of the biggest advantages that money market has above capital markets. There's a saying that the higher the risk, the higher the return, right? So in capital markets, the risk is significantly higher compared to the money market because it has very high liquidity. Since you have the ability to sell the instrument at any point of time, pretty much within 1 year, that provides the investor an option to get high liquidity. Whenever there is high liquidity, you generally have much lower risk, and whenever you have lower risk, the return on investment will also be very low. So for the next will be the comparison on the purpose of loan. Why do people invest in money market instruments? To serve their short-term credit needs. And why do people invest here in capital markets? Because it provides them fixed capital, so they can buy assets with the money which they make in the capital market. So these are some of the differences. I'll give you one more. Return on investment is lower on the money market side, and on the capital market side it is returns are significantly higher. Plus, let's move on to different parts of the money market. There are majorly 6 parts of the money market which is covered under our syllabus, being the call money market, which is one of the shortest maturity markets in the entire world, followed by an interbank term deposit. Try to understand the definition from the words itself. Interbank meaning bank to bank transaction, deposit meaning a fixed sum of money, term meaning a fixed maturity. Interbank term deposits are only between commercial banks and financial institutions. Participation certificates are a type of hybrid instrument which we have already learnt in the debt market chapter. We also have the commercial bills, and the biggest market here is the treasury bill market for the different money market instruments. The last one being the intercorporate market, similar to interbank market. An intercorporate market is one where two companies exchange short-term maturing instruments over the money market so that they can always satisfy their liquidity based needs. There are some disadvantages though. Number one being the very narrow base that this market has. Only RBI, banks, LIC and UT are the major participants in this market. Being such limited entities, you cannot expect to raise significant amount of funds if you're a company. Plus, since there are very few money market instruments, you don't have much of a variety. Almost all of them have similar features, so very few options available to investors, and the interest rates are not determined by market. Can you guess who determines this? Yes, the Reserve Bank of India is one of the main factors for determining the interest rate, and sometimes even there is a voluntary agreement between the participants of this market through the banking association. So banks play a significant role in determining the interest rates of this particular market. Therefore, lesser number of options available to investors, very narrow base, and the interest being determined by banks and RBI rather than the participants are some of the 3 biggest advantages of the money market. So how does this market really work? What is the structure? The structure is divided into 2 parts which I'll discuss later, but mainly the bankers, since they play such an important role, the bankers acceptance market and the commercial paper market are places which have very similar features with each other. There is a lot of interoperability between them. The treasury bill and the commercial paper market also sometimes has interoperability, and the treasury bill followed by the call money market, which has the shortest maturity. There are some treasury bills which also are having very short maturity, so some of them also spill over to the territory of the call money market. So this is where all the segments. These are the important segments between the different markets of the money market, followed by the structure. So money market is basically divided into the organized and the unorganized segment. The organized segment obviously has all the major players, Reserve Bank and the State Bank of India, the different associate banks, the private and public sector, commercial banks and foreign banks. All of these are major players in the organized sector, but the unorganized sector still has some people. For example, classically the money lenders, the indigenous bankers, the non-banking financial intermediaries like chit funds are major players for short-term finance needs for the people of this country. So since money market also focuses on the short term, we could call them also as part of the unorganized money market. Let's see the money market instruments for which the highest weightage is given in this chapter. The first and most important amongst them is the treasury bills. Since this is the most important one, there are many types of treasury bills also covered in this subject. So treasury bills are basically instruments which are issued by RBI by making an entry in the subsidiary general ledger. SGL is what they call. And since RBI is issuing it, for whom does RBI raise money? For the government of India or for state governments? So treasury bills are generally ways for the government of the country to raise money from the public through the money market. So treasury bills are very useful for deploying the short term surpluses available with the country's investors and using it for developmental projects. Furthermore, treasury bills are of 4 types based on the number of days of maturity. So you have the 14-day, which is pretty much 2 weeks, the 91-day treasury bill, which is 3 months approximately. You have the 182-day treasury bill, which is around 6 months, and the 364-day treasury bill, 1 day less than 1 year, which is the last and the most highest maturity treasury bill amongst these. The biggest advantage of the treasury bill is since the government of India itself is issuing these, there is no TDS which is deducted as source, and there is no default risk at all. These are called as sovereign or government papers, because the government of India is the party who's taking money from you as an investor. They will repay it back. So if you want the most secure investment possible in this country, even more than the fixed deposits which you think are very safe, it is going to be always the treasury bills. These are very highly liquid. There are 4 types. So if you want money only for 2 weeks, you can go for the 14-day treasury bill. If you want money for 3 months, you can go for the 91-day treasury bill. So very flexible and highly liquid with comparatively better returns, not because the government pays you very high returns, but because of the TDS component being there. Lot of transparency, because the government will tell you when the exact maturity will be, and the settlement is very simple because RBI is handling all the settlement aspect of this instrument here. Furthermore, these are very highly tradable, and they have an active secondary market where you can actually sell the treasury bill. So you can take the treasury bill, you can invest in it, and then you can, as soon as you invest it in the primary market. So primary market is the place where investments happen. Secondary market is the place where the trading happens. Trading means buying and selling. So once you receive it through the primary market, you can go to the secondary market. Both of these are actually handled by the stock exchanges of India. So some more features of the treasury bills are: number 1, they have been issued in the form of a promissory note, which basically means that these are issued in a physical format. And since they are issued in the form of a entry in the subsidiary general ledger of RBI, you don't really have to have a demat account to buy a treasury bill. So it's very convenient. The minimum bidding amount that you need to bid is 25,000 rupees, and these are generally issued at discount. Therefore, for 25,000 rupees, you might get more number of units if you equate it on a discounted basis, and I'll tell you how to do it when you do the yield calculation. And furthermore, all the banks, financial institutions, primary dealers and companies generally play a big part in investing in these type of treasury bills. So the major players in the treasury bill market are these parties. Furthermore, the repayment is generally made on par. So that means, let's say the unit is issued at 97, it will be redeemed at 100 per unit. But How many units do you have to buy? You have to buy 2,500 units, which will be 25,000. That is the maturity value. So how many units you need to buy at 97? It will be more. Let's say around 25,500 units is what you need to buy in terms of the number of units. So you'll probably get 2,550 units at 97 rupees. Not an exact calculation. You can do the same. Based on this, your yield will be $3. That is your return on investment, but the yield calculation is done slightly differently. The maximum day count for these treasury bills is 365 days. So how is the yield calculated for a treasury bill? P refers to the price that you have paid for the treasury bill. 365 is the number of days in a year. 100 is because of the interest component. Multiply the price with the number of days left to maturity. That will give you what is called as a yield. Because treasury bills are traded on the secondary market, the yield calculation is more relevant rather than the overall gross return on investment. So if you bought a treasury bill at 97 on 1st June 2019, followed by it being sold on 20th June 2019, so you have 19 days to maturity. Your yield will be 100 minus 97 into 365 into 100 divided by 97 into 19, number of days to maturity. That is how you calculate yield. Sometimes they'll give you the yield as an answer. You might have to calculate what is the price. These are the two types of question which might actually come in the exam. Some examples are given in the textbook. Please go through them and get back if you have doubts for the individual questions that you may have trouble with. And once yields is calculated, all you need to make sure is make a investment decision. So when you buy a treasury bill, you approach the primary market and it is sold through an auction technique. Auction techniques also will be explained to you a little later, but all the auctions are done by the Reserve Bank of India, and only at RBI does the treasury bill auction occur. There are two types of auction: French auctions and Dutch auctions. All right, and once these auctions are done, they'll give you a time, and generally it is 2:30 p.m. on a Wednesday is when bids are to be submitted on the negotiated dealing system. So each person has to bid and they'll arrive at a price. So very similar to a book building process in terms of bidding happens for a treasury bill. And if Wednesday happens to be a holiday, then previous day the bids will be taken. Once you have done this, the price is always going to be 100 rupees. That is going to be the maturity price. So if you have a 91-day treasury bill auction, you have to submit bids from the perspective of that being maturing at 100 rupees. The auction committee of the RBI will decide the final price or the cutoff price. Below that cutoff price, whoever has bid, they will not receive the treasury bill, so their money will be refunded. All those people who are bid above the cutoff price will be getting the treasury bills at either the cutoff price or at the price they have respectively bid at. That is where you need to understand what auction really is, and that results are announced on the same day. Furthermore, bids above the cutoff price receive full allotment. So 100% allotment made. Bids at the cutoff price may either receive full or pro rata allotment based on how many bids are received for that particular treasury bill. Now, since you have received the treasury bill, now you move to the secondary market component. So here they can take the secondary market option which is available for treasury bill and sell it on a stock exchange. So the advantages are you will always get a market based yield. So the price which is available in the market might not be the price which you would have got. You would obviously make a profit on the same. Plus, if you are doing a treasury bill transaction of less than 15 days, so fund management is very, very easy for the same. Plus, since this is done through RBI's SGL account, and gilt-edged accounts of the government, there is a lot of transparency involved. So huge advantages for the treasury bill market, and there is huge amounts of money also during Wednesdays. They will offer a two-way quote for primary dealers. Primary dealers, you will understand the later chapters, are special types of persons who combine the aspects of underwriting and market making. So these people will purchase and sell treasury bills at a certain fixed rate. They will have a prefixed rate at which you can buy and sell. So they are like, you can say, a sort of broker for treasury bills to be traded, and you always have an option to enter and exit whenever you feel like. So you can sell the treasury bill even before the 91-day maturity if you want the money urgently. That is where the liquidity component is very, very strong. So what are the two types of auction? I already told you there are two types of auctions. One is called French, which is nothing but multiple price based auction, and Dutch auction. Dutch auction, you will get it at the cutoff level. So if the cutoff price was 97 and you have bid 98, you will receive a refund of 1 rupees. That is what is a Dutch auction. There is a very famous saying called going Dutch. Dutch is nothing but Netherlands, so they always have the fair way of determining most dealings and transactions in business. So that is probably one of the reasons why this is called as a Dutch auction. Whereas in France, most of the older generation used to be aristocrats and they were business focused individuals. So maybe why that is one of the reasons why this is called as a French auction, because generally things are more expensive in France than they generally should be, is my logic to remember both of these. In a French auction, all the bids are accepted at the cutoff price or above, but you will be getting it at the bidding price. So if you bid 97 and the cutoff is 97, no problem, you got lucky, you get it at 97. But if you bid 98 and the cutoff price is 97, you don't get the refund of 1 rupee. So you get all the units at 98 only. So it's pretty much like a loss for you if it is a French auction. That is why most entities will prefer a French auction compared to a Dutch auction.
Subscribe to LearnCab and hit the bell icon to get notified.